Are you ready for a financial roller coaster ride that's surprisingly steady? The Federal Reserve recently announced earlier this month that the interest rate is expected to remain steady. What does this mean for the alternative business finance industry? Well, we're going to talk more about it in today's episode. I'm Jordan Hansen, and this is Beyond Banks, a show that focuses on items and news that is relevant and important for the alternative business finance industry. It is sponsored by Cobalt Intelligence, a piece of software that really can help you streamline your underwriting process, eliminating manual checks such as Secretary of State, court judgments, TIN verification. You know those annoying things your underwriters have to do. We can help you eliminate those. Okay, let's talk more about this interest rate remaining steady. So here's the video where Jerome Powell, the Federal Reserve Chair, talks more about it.
Inflation down, that probably means that certainly means that it will be appropriate to cut rates at such time as inflation is coming down really significantly. And again, we're talking about a couple years out. I think, as anyone can see, not a single person on the committee wrote down a rate cut this year, nor do I think it is at all likely to be appropriate if you think about it. Inflation has not really moved down. It is not so far reacted much to our existing rate hikes, and so we're going to have to keep at it. You know, if you look.
So you can see there, Jerome Powell, the Federal Reserve Chair, he talks more about how the rates are going to remain the same because inflation hasn't reacted much to their interest rate hikes so far. Now, hopefully, that doesn't mean more rate increases because that significantly impacts the alternative business finance industry. Now, there's good news and bad news when we're talking about this. The bad news, as we know, that as these interest rates have gone up, so essentially the cost of capital goes up. So this means that when we're trying to lend or offer deals, when you're trying to offer deals to merchants, this costs a lot more money when you're offering these deals because, of course, where you source the money from, the interest rates, all that goes up in price, and so it costs more money to give them. So it makes deals maybe harder to close. But hopefully this gets easier as time goes on, because if these remain steady, then the expected cost of capital remains steady as well. People will be used to it. They'll know how to understand it. It's a little more stable, and investors can even be a little bit more, they know what to expect, and so they're more willing to maybe invest in this opportunity, this industry, as well as just business borrowing in general. All of it is a little more stable. Now, that's better than interest rates going up because that hurts this industry for sure. People get scared. All of a sudden, everything costs a lot more and slows these kinds of things down. So remaining steady certainly is better than interest rates going up. Interest rates going down, of course, that's better for the industry because now we can offer this money, this funding at a lot better rates. I'm Jordan Hansen. This has been Beyond Banks. I hope this has been helpful for you. Just as you know, as you're going forward, just plan for interest rates to remain about the same. And hopefully this has been helpful. Hit the like and subscribe button, and we'll talk more later.